everyone, welcome back. This is your June 2026 real estate market update brought to you by the Reby Homes team. Whether you're a buyer, a seller, or just keeping an eye on the market, you're in the right place. So let's get into it. Starting with the national overview, let's take a look at some forecasts. Heading into 2026, the forecast was pretty optimistic. More home sales, lower rates, a stronger year. But that's not exactly how the first half has played out. Rates have moved up, affordability has stayed heavy, and the forecasts have since been revised across the board. So here's where they started versus where we are now. The forecast for total home sales was expected to be around 5.2 million, and we're at 4.9 million. Existing home sales plus 14%, that's now plus 4%. New home sales plus 5%, that stayed the same. Median home price also stayed the same, around 4%, with some expecting maybe 2 to 3. Mortgage rates were supposed to be around 6%, and they are at 6.5%. Job gains were expected to be 800,000, and that's been cut in half. We're now at 400,000. And the unemployment rate was predicted to be around 4.6%, and that's since been revised to 4.5%. Bottom line, it's shaping up to be a relatively flat year for home sales nationally. It's not a crash, though. It's not a collapse. It's just the market navigating real affordability pressure and a lot of uncertainty. Rates have moved up, people are cautious, and that's showing up in the numbers. Now let's talk about prices because that's where it gets interesting. Nationally, home price growth has been slowing for most of the past 12 months, not falling, just slowing. There's a difference and it matters. The reason is pretty simple. It comes down to inventory. Markets where supply is still tight, think pockets like the Northeast and Midwest, prices are still climbing. Markets where inventory has surged back above pre-pandemic levels, Texas, Florida, Colorado, you're seeing softer pricing or flat appreciation. It's not complicated. Show me a market with low inventory, and I'll show you rising prices. Show me a market with flooded listings, and I'll show you prices softening. Right now, 17 states are back above their 2019 inventory levels. Most of them are in the South and the West, and price performance is following inventory almost exactly. That's the story of this market. One more thing on prices, there are no signals pointing to a major drop. Why? Because we don't have forced sellers. People aren't losing their homes en masse. It's not 2008. Speaking of 2008, foreclosures are rising, and you're going to start seeing headlines like that everywhere. Yes, we're running at around 100,000 plus filings per quarter nationally, but zoom out for a second. In 2008, 9 million people went through a distressed transaction. So we're nowhere near that. The reason this market is fundamentally different comes down to two things. First, over 50% of homeowners with a mortgage are locked in below 4%. Most of them can't even rent an apartment for what their mortgage payment currently is, so they're not going anywhere. Second is equity. Nearly 40% of homes in this country are owned free and clear. 2/3 of homeowners either have no mortgage or have more than 50% equity in their home. So there's not a lot of forced sellers here. The U.S. housing market is sitting on $34 trillion in equity against only $14 trillion in debt. That's a pretty strong market. So with rates where they are and all the noise out there, why are people still buying? Well, because life doesn't wait for a perfect rate. New jobs, growing families, divorce, retirement, wanting to be closer to family, these are all things driving transactions right now. The number one reason people are buying is to be closer to family. That's not a rate-driven market, that's life-driven. And here's something worth noting for buyers. If someone has their home on the market right now, they're a motivated seller. They're not testing the market, they need to move. That creates real opportunity for buyers who are ready to act. Bottom line, the headlines will try to scare you, rising foreclosures, softening prices, slowing sales, but the data tells a more balanced story. The market is navigating real headwinds, the foundation is solid, equity's high, forced sellers are rare, and life events keep people moving no matter what rates are doing. And now let's take a look at our local market here in the Phoenix metro area, starting with inventory and supply. Right now, we have about 28,500 active listings across the Phoenix metro area, and that number has actually been trending down a little bit from a peak of around 30,000 just 3 months ago. But if we take out homes that are under contract, that number is sitting closer to 25,000 active listings, which is still fantastic for buyers. And although that 3.7% shift down from last year isn't significant, it does help after 2 years of rapid inventory growth. In 2024, supply was up over 57% annually, so it seems as though that wave has started reversing. Now let's talk about what everyone really wants to know, prices. The median sales price this month came in at $455,000, which is up from $452,000 last month, and just a tick above the $449,900 that we saw a year ago. The annual median has held steady at $450,000 for several months, which signals a stable market, not crashing but not spiking. Buyers benefit from this because with stability comes opportunity. For the sellers who have owned for a long time and have strong equity, they're able to cater to buyer needs and still walk away with a profit. For others, their lack of equity might land them at the closing table with little proceeds, breaking even, or possibly even writing a check to close. And that is the unfortunate reality for many sellers right now. The average sales price is just under 626,000 for the month and just under 612,000 on a trailing annual basis. Average is always skewed a little bit because of luxury sales, so that spread between median and average sales tell us the high end is still very active. On a price per square foot basis, monthly sales are at 302.36 a square foot. Appreciation is up 3% month over month, and that's a strong monthly print. Annually, we're up 0.7%, which is modest but positive. And as always, keep in mind that this is heavily location dependent. On the demand side, the market is holding up pretty well. We closed approximately 7,500 sales this month, which is up from 6,500 last quarter and virtually identical to what we saw last year. The annual sales rate has climbed to just over 76,700 closings, and that's up 7.6% year over year. So buyers are absolutely still out there. They're just cautious. Monthly dollar volume came in at 4.66 billion, and on an annual basis, that's nearly 47 billion in real estate activity just in the Phoenix metro area alone. So this is a pretty enormous market. Homes are selling at 97.34% of list price on average, essentially unchanged from a year ago. Sellers are pricing well and buyers are meeting them close to ask. No dramatic discounting happening, although one thing that isn't publicly shown is seller paid closing costs. This is also known as seller concessions, and that number is sitting around 55%, and it's been over 50% since this time last year. The average concession is about $10,000, so that is something to factor in. But let's zoom out and look at the bigger picture. The Cromford Market Index is a proprietary score that measures buyer and seller conditions. Anything below 100 favors buyers, and anything above 100 favors sellers. The CMI right now is 81.6. So yes, we are technically in a buyer favoring market, but just barely, and it's been trending up from 72 a year ago. What's interesting is the breakdown. The supply index is at 103.8, meaning supply is slightly above normal, but the demand index has climbed to 84.6, which is a significant increase from 77 last year. Buyers are coming back into the market, demand is strengthening while supply is starting to shrink a little bit, and that's a recipe for the market moving towards balance or even seller territory heading into the second half of 2026. Contract ratio measures how many homes are under contract relative to active inventory, and that's at 32.4. Compare that to just 2 years ago, it was at 44.7, so we still have room to grow, but the trend over the past quarter has been moving in sellers' favor. If you're a buyer, you still have leverage. We're in buyer's territory, inventory is available, and sellers are willing to negotiate. Days on market are at 84 on average, giving you time to be thoughtful. But don't sleep on it. Supply is starting to pull back a bit, demand is climbing, and that window might be narrowing. If you're a seller, price strategically. Homes are selling at 97.34% of list price, which means if you price right, you'll sell. But overpricing will hurt you. The listing success rate is 69.8, meaning 1 in 3 listings isn't closing, and that is significant. Get the price right from day one and avoid being that one that doesn't close. And if you're watching the market as an investor or just a curious homeowner, the stability we're seeing in the median price, the rising annual sales rate, and the shrinking supply are all signals that the Phoenix metro market is on solid footing heading into the back half of 2026. And that wraps up our June 2026 market update. If you have any questions about what this means for your specific situation, please don't hesitate to reach out. We're always happy to help. Thanks so much for tuning in, and we'll see you next month.